how do you go about underwriting every specific little thing? What are little key points you look at that make you feel comfortable with moving forward with a deal? If you are in the multifamily or commercial space and you get sent a book from a broker, they're almost always going to give you their underwriting to show you, hey, this property is worth X today and it's worth Y in the future, and you can make Z, so you should buy at the price I'm asking for. Maybe it's worth it, maybe it's not. But when you're looking at their underwriting, they are trying to sell you a property. So take everything they tell you with a grain of salt. Some of the stuff is going to be correct, like a lot of the property information, the renovation plan, the average rent, the stuff in the book for that is 99 times out of 100 correct or very, very close, that you can take it with, without the grain of salt. But things like you can push the rent to Y and you can spend X to get it there, or you can operate your property at $5,000 a door, or $300,000, depending upon what it is. That stuff, I would always do your own underwriting. I was speaking with our small balance lender for Freddie Mac at CBRE, and he was telling me that there's a lot of people that buy their own deals and they literally just submit the broker's underwriting. And I'm just shaking my head thinking the amount of books I've seen that are just wrong, or just not even wrong, just how we wouldn't operate the property, is mind-boggling. And sometimes it's the other way too, right? Sometimes it's too expensive and sometimes it's, way cheaper. And I'll get sent a book if it's higher than what we can do. I'm super happy because I'm like, okay, if everybody thinks that, or, a bunch of people, but I can do this, that's a great thing. If it's way low, I'm going to be like, what are you thinking? So always do your own stuff. The way we get our information is track record, experience, property management, other properties, things of that nature. So, we'll never buy the first deal in a market that we see unless we have other resources. And what we'll do is those broker books, all right, we'll start looking at what other people's expenses are. Our property manager will always, manage deals in that area. We'll leverage the other properties that they manage. They'll do their underwriting, we'll do our underwriting, and we'll communicate in between ours. And we'll look at, what do we think we can operate this at? What are our expenses going to be? What is our income going to be? For the rent side, we will look at all the properties close by. We'll start directly in there, and then we'll spread out, and we'll look at, renovation scope, square footage, and what the rents they're achieving are. And then we'll plug those scenarios in and kind of see, okay, well, if we do this renovation, we can take it from 600 to 700. But if we do this one, we can go from 600 to 750. But it's going to be more expensive. So, what's your ROI to get you to 750? Does it make sense? Or do we do less and go, only to 675? And, we'll look at things like that, and we'll see, how many units are already renovated? How many do we want to leave left for the next buyer? Do we want to do multi-level, renovations? Do we want to do two different types so that there's a variety for the tenant as they come in, as well as the next buyer can choose to do, either one, and you can prove out both? Do we want to renovate the whole property and sell it as a stable? So there's a lot of different factors we'll go into, and depending upon what type of renovation we do, because we buy all value add. So this is talking for value add, not necessarily stable property. Will depend on, the cap rate you sell out at the end. That's the other thing too. A broker is always going to take today's cap rate, and they may even go lower. We will always take the cap rate and make it higher to be safe. And how high we go just depends on, how much meat is left on the bones, how much value is left, what's the area like, what do we think the market is going to be like in 2, 3, 5, 7 years, et cetera. And it's always a sliding scale. But just want to make sure I'm catching every little thing. But the way we kind of get all that information is, past experience, other deals, other information from other books and brokers. We have, if we look at 10 other deals, they'll send you the financials for those 10 deals. So I'll take those financials, I'll look at how they were operating and say, all the, the payroll is $1,100 a unit. If the current owner is at $1,500, all right, there's an expense I can probably cut. Maybe I can't get 1,100. Maybe there's a reason for that, but maybe I can get 1,200. Or maybe they're super low. Maybe they're at 700 because they're a mom and pop, or they've had somebody working there for 15 years. And if you go to the free market, you're not going to find that rate for a manager anymore. So I know, okay, well, that rate's going to go up. The tax side of things, we'll do two things. We'll, one, figure out how it works in the area, and two, we also have third-party tax consultants that we will use, especially for a new market, to make sure. So, for example, right now we're really, really, really strongly pursuing buying multifamily in the Indianapolis market. We're in a bit of a discrepancy right now because our tax guys telling us one thing and the brokers are telling us another thing, and they're very reputable brokers. They're only Indianapolis based, so they know the market like the back of their hand, and we're trying to figure out, what the real story is and, how to figure it out. So, we've looked at a couple deals. We were going to offer on the last one, but then, our tax guys told us it was going to go up, 80% reassessed of the purchase. Brokers were telling us it was like 45, 50. It was a big difference. So we weren't really sure. So we said, let's see, what happens with this one. Let's use it as a case study. We really liked the property. We were actually at market value, but it was an opportunity cost that we weren't willing to take a gamble on. And we said, let's use this as a case study for the next 6 months going forward. So, we'll look at things like that and see what happens and see what does actually happen with the reassessment. Is it 50 or is it 80? And if it goes to 80, well then, wow, it's a good thing we didn't buy that. If it goes to 50, all right, we missed the deal, but we didn't lose money. We lost an opportunity. That's not the end of the world. In terms of scenarios, because that's kind of the second part, he was asking, do you guys do best case, worst case? We will stress test every single deal we look at. We'll look at, what cap rate will get me a net zero return, and make sure that it's super high, like an 8 cap. And that's even with positive cash flow every year. That means technically you're selling it for less money than you bought it for, but the cash flow and the sale net out. What is that like? If it's a 6.5 cap, we're never buying that deal for that price. That's way overpriced, and it's just not happening in the markets we're in. If it's an 8 cap, all right, we feel pretty safe. If, in the next 5 years, if that's our business plan, if, cap rates go to 8, everyone's kind of getting shafted a little bit, so we'll be in good company, but at least we know, hey, we didn't lose anybody any money. We didn't make anything, we didn't lose anything, or we'll be pretty close to net even. The other thing, we'll look at is our break-even occupancy. Where can our income come down to so that we can still afford to pay our expenses and our mortgage every month, and we don't have to call investors to raise additional money or to tap into our reserves or a capital fund if we're doing upgrades or renovations. We don't want to do that. So we want to look, and we really look for, in and around 70%, because that would be a pretty significant drop. So we definitely look at it from that scenario. And what we'll also do is we'll look at, a lot of times, like I said, we'll sell at a lower cap rate than it is today. If it's a 5 cap, we may put a 5.5. If it's a 5.5, we may put a 6. Whatever it may be, we'll look at a sale and say, okay, let's say it stays the same. How does this look? And we'll say, okay, that seems pretty good. And then we'll drop it to a 6, and we'll present it as a 6 to other people. But we'll know that if all things being equal, we think we can do a lot better than we have on paper, and that's why most of the deals that we've done, are well and above 20% returns to investors, even though we're telling people 12, 15, 18, just because cap rates have, not only compressed, well, they've compressed or stayed level in the last couple of years. So that's why we've, continued to outperform for the most part. There's deals that we have not outperformed on for various reasons, but, for the most part, on average, our deals are over that. So, and then that stress test of, what is it, what does a 7 cap get us? Is it 10%, 12%? We'll look at that just to understand what it is. So we'll definitely stress test. We'll do what we can to make sure, hey, if it, what's the chances it drops to 70? And are we okay with that? We don't think we'll probably drop to 70 because that's pretty safe. So we're usually pretty comfortable there. If we start getting mid 70s to upwards to 80, unless it's a really quick turnaround, we're doing a lot of renovations and it's a big lift, we're probably going to avoid it. It probably just doesn't sit right, or we'll drop the debt. So instead, usually the break even gets higher as you get, a higher levered loan. So if that break even occupancy is too high, we'll just get less debt to make it less risk averse. And if the returns aren't there, we'll either lower our offer or we'll move on. So there's a lot of things we'll look at. We're definitely doing a lot of our own stuff. We're definitely double checking. We're definitely stress testing. And I would encourage all of you, whether it's a single family house or a 300 unit, multifamily property, to really do the same stuff and feel very comfortable in what you're doing, and know that, if this happens, I'm still safe and I'm not losing money.